Welcome to today's webinar on general business conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Ron will be entertaining questions at the end of his presentation. If you have a question, please type it in the chat box on Zoom. We'd love to get your feedback at the end of this presentation, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. I also want to note that the views expressed during this presentation are the presenters and not those of the Minneapolis Fed or the Federal Reserve System. Now, before we get into the survey results, I'm going to provide a little background on the General Business Survey. The General Business Conditions Survey is one of the largest surveys of businesses conducted among the 12 regional reserve banks. This is really possible thanks to our partnerships with chambers, government agencies, and other business groups who send this survey to their contacts on our behalf. So a huge thank you to all of our partners who help make this possible. Now, the survey we're discussing today was conducted between July 10th and July 24th. We got 555 responses from business owners across the region, and I just have to give a huge shout out to our South Dakota and Greater Minnesota partners who really brought in a lot of responses this round. We continue to see a good balance by both firm size and sector, but it's important to note that these responses do not come from a random or representative sample. Because of this, the results of this survey should be seen as more of a snapshot of current conditions and interpreted carefully. And with that, I'll let Ron take it away.
Thank you very much, Haley. I appreciate the introduction. I appreciate everyone showing up today. I think there's some interesting things to chat about in this survey. And again, just to kind of repeat some of the things that Haley had said, for any partners that are out there listening and for any people that have taken this survey, we really appreciate the feedback. These surveys are really important to the Minneapolis Fed. They really give our president, Neil Kashkari, some great insight into the current economy. And it gives the rest of the staff a lot of things to think about in terms of where the economy is going in general. So what did we talk? What did we learn? Here are a few quick takeaways. So in general, the most recent 3-month period saw some kind of mixed revenue, but overall profits were lower and trending lower, unfortunately. Large firms continue to outperform smaller firms. I'll talk a little bit about that, but the gaps seem to be narrowing a little bit and probably not in the right way that we would hope. Demand for workers continues. I think that continues to be a real a silver lining in all of the things that are happening and all the challenges that we're seeing in the economy. We are, however, seeing a little bit of moderating in terms of the types of hiring that firms are doing. Higher interest rates, I think everybody's very familiar with. They are becoming more challenging to a lot more firms. Inflation is still a concern. We're seeing a little bit of pullback in terms of some of the price pressures that people are seeing, that firms are seeing, but they are still overall high. Labor availability is getting better. That's what firms told us. Overall, I would still call it poor. Wage pressures also remain quite strong. They seem to be kind of flattening out, but flattening out at fairly high levels. And overall, the outlook, again, this has been kind of a very steady drumbeat from a lot of firms over the time, is that despite the fact that there's still lots of challenges, overall sentiment is still modestly positive. I think that's a good sign for the economy in general. I'll talk a little bit more about that at the end. So let's talk about some of the individual questions and data points. So first, let's talk about revenue. So again, for those that might not be familiar with how we structure the presentation here, the first question we always ask is about recent quarterly revenue, and we compare it to the prior quarter. That's the top bar, and then the same quarter as last year, so year over year. And then we want a little peek into the future, and that's the bottom chart, the bottom bar that asks about the coming quarter compared to the compared to the one last year. In terms of the color scheme here, green means good, growth. Red means bad, decline. And it doesn't necessarily mean negative profits or negative revenue. It simply means that compared to that period, it was lower than the comparison period. And generally what you see here, I think the general message that I take away here is that revenues are flat. There's really a lot of barbell kind of activity going on. A fair number are seeing growth, but a fair number are also seeing decline. And so I think that's what we've been seeing. I'll show you a chart in a little bit that shows that some of this behavior is kind of a continuance of what we've been seeing. I also want to introduce the fact that there might be some compositional factors at play here. I'm going to talk a little bit more about that. So we also saw that profits declined, and here the story is, I think, a little bit more clear and a little bit more negative. So this is similar to what we saw in January, is that profits generally, regardless of the comparison period, are fairly negative. So if we look a little bit closer into that composition part, is first over time, what I wanted to show you is that, so the chart on the left is the year-over-year comparison in revenue over the last 2 years, roughly. And what you see there is that if you look especially at the July, the very bottom bar compared to 2 bars up, the July 2022, is that we haven't seen a whole lot of change. It's kind of a good news and bad news. You know, certainly we'd like to see more improvement in that number, but given high inflation and some of the other pressures, I would say the fact that they're still fairly similar is not necessarily a bad thing either. In terms of the future expectations, go to the chart on the right. Again, what I would say is we haven't been seeing much change from firms in terms of what their outlook in terms of revenue is concerned over the last several surveys. So we do also ask firms to tell us a little bit about themselves. So they identify themselves by size in terms of full-time equivalent employees. We also ask them to identify their state, and we ask them to identify the sector they're in. That's this chart right here. And first, I want to note that some of these sectors have fairly small samples. So as Haley mentioned earlier, please interpret especially this chart with some caution. I'm going to talk a little bit about it. So in terms of sector breakdown, what you see is that retail trade are most negative in terms of their sentiment, in terms of their revenue trends over the last quarter. What I would tell you is that it had a really strong response. More than 100 respondents in this survey of about 550 were in retail. That's a higher than normal number. And we had really strong participation in South Dakota among the retail trade firms. And so the fact that they are doing not as well, certainly not good for them. What I would say is in terms of the overall trend, this is pulling the overall results probably a little bit lower than you might otherwise see if you had seen a more normal retail trade proportional response. It has showed, it has slowed, and we are seeing that in some other spots in terms of some of our survey work, but we also have seen a little bit more positive response in some of the other surveys that we are doing. For example, I do a hospitality and tourism survey, a lot of retail firms in that. I'm seeing a little bit more positive results overall compared to this one. And the other thing too to note is that retail and accommodation did really well last summer. And remember, when we're doing comparisons year over year, there is some of that. If you had a really strong year, your comparison might be lower. It doesn't mean you're doing poorly. Again, I don't want to whitewash the idea that retail trade and accommodations were not seeing particularly strong results this survey, but I do want to kind of offer some of those caveats. In terms of revenues by state, again, what you see here, fairly similar in many instances. You see South Dakota at the very top, and I point this out because, again, we had really strong response from South Dakota, but we had really high representation in retail and accommodation and food, which was doing more poorly. So again, from an overall standpoint, I think there is some similarity here, and the differences, I think I can probably contribute at least somewhat to that compositional factor. In terms of revenues by size, this has been the most consistent indicator in terms of kind of breaking things down a little bit. We have very consistently seen that larger firms are doing better than smaller firms. The thing we saw in this survey is that there's been a little compression in terms of how much better larger firms are doing than smaller firms. Given the fact that there's an outsized role in the economy for large companies hire, they employ most people. They also are responsible for a large share of GDP. I think that's why we are seeing output growth. It's also why we're seeing employment growth, which I'll talk about in a little bit. We also see that here that in terms of company size, you're also seeing a little bit of a flip-flop in what we had been seeing in terms of performance. Here, I think one of the things that we might be seeing in this case where we're seeing profits decline more strongly among larger firms is potentially because they were seeing outsized profits earlier in the pandemic. It's hard to say exactly what's happening here. Certainly not a good trend regardless. So let's talk a little bit about workforce and wage trends. There's good news and bad good news and less good news as it relates to regarding hiring right now. In general, what I would take across from this, and here we're comparing last year's survey in the orange to this year's survey in the blue. And what you're generally seeing here is that most firms are still hiring. If you look at the very left of the chart, very few are cutting employees. Okay, there is an uptick in those that are not hiring. Roughly 7-8% of more firms are not hiring in this cycle compared to last year. More are hiring to replace turnover. Still a good thing that they're hiring, but not a good thing that they're replacing a lot of employees. The thing that I would note most is the chart on the very left, the bars on the very left, and that is that we're seeing a decline in the hiring of additional full-time workers. I think that's a pretty strong signal that maybe we're seeing a little bit of moderation in terms of labor demand. I would still call it healthy, but I think it's notable that we're seeing that the decrease in that full-time hiring in particular. So the other thing we ask is, tell us about how your staffing has changed compared to the previous quarter. And this has been a pretty persistent finding or result in our survey that I'd like to explain just a little bit. So it's been fairly consistent that more firms say they have smaller staffs compared to those that say they have larger staffs now compared to the previous quarter. And I think it bears a little bit of explanation when we've seen consistently rising total employment. How exactly do those things jibe? And I think I kind of referenced it a little bit ago. And that's mostly because we're seeing fairly strong employment growth among large firms. Again, they have a large share of overall employment. So the fact that those firms are growing is probably what is driving overall employment. I think it also suggests that as you get smaller, you're having a lot of difficulty hiring. I think there's a number of reasons for that. One of them is wage increases, which is something I'll talk about in a little bit. We also see that future staffing appears to maybe be slowing. Again, I'm going to qualify this a little bit. If you look at the chart on the left, we ask, what do you expect your future staffing to look like in 6 months compared with current? And if you look at the very bottom, the July 2023 survey, you do see that those that are expecting growth has pulled back a fair bit. And the share that expects it to decrease has inched up a little bit, fairly similar to last year's survey, but more notable is that there's a notably smaller share expecting to see growth. If you look over to the other charts, though, I think some of the explanation might lie in, again, some of that compositional factor. We see that South Dakota, which had a really high share of retail and accommodation, they are seeing a very negative trend in terms of who's expecting to add or decrease staffing. If you look at the bottom of that top chart, Minneapolis-St. Paul, which has a more, what I would say, a more generalizable composition, more similar to what the overall economy might look like. I would say here we're seeing a little bit stronger, much stronger growth. And given the size of Minneapolis-St. Paul, I would say that's a fairly positive trend to be looking at in itself. So again, I think there might be something to be said there. Again, going back to the firm size factor, the fact that the larger firms are also continuing to see larger staffs going forward. They plan to continue hiring, in fact, fairly aggressively compared to to firms of other sizes. Again, I think we can expect to see this. To me, suggests that employment growth. Hard to say exactly how much, but this to me says it's more of the same. So there's lots of challenges in the economy. Let's talk about some of those. So we asked firms to tell us, what are your 2 greatest challenges to your business? And I have 3 circles pointed out because there's 3 different things I'd really like to point out, maybe a couple additional points as well. But what we're seeing is a shifting in challenges. Not that there are none. Everyone listening knows that there are lots of challenges. Higher interest rates, though, now got on the radar significantly last year, increased in January, and now are the top concern among businesses in terms of their challenges. We are seeing that labor tightness is persisting and changed a little bit, decreased a little bit, possibly because other challenges are coming more to the fore. Fewer saw inflation as a problem. So we did see a fair improvement in terms of those that see inflation as their top concern. And then the last thing, this is something that, was really prevalent maybe a year and a half ago in terms of supply chain, that middle one where supply chain disruptions, we're continuing to see increased improvement in that as a challenge as well, which is good news. In terms of prices, I would say it's a good news, bad news, or good news, less good news. So because we are seeing improvement, so we have two charts here. The left one represents wholesale prices, so the prices that firms are paying to their vendors. And then we have the final prices to customers, or the retail trend. And if you look from July 2022 to the bottom one, 2023, what you're seeing is some improvement. I would call it modest at best. But it is going in the right direction. And we are seeing that prices to consumers are improving a little bit faster, especially in terms of those that are citing really high increases to their retail customers. So that's going down a little bit faster than we're seeing on the wholesale level. Obviously, firm owners are still suffering from pretty high price input inflation from their vendors, but it is coming down. In terms of labor availability, we are seeing this improve. I think we've been hearing this anecdotally really for multiple months. I think this survey really suggests that that is happening. If you look at the chart on the left, those that are having extreme difficulty finding labor really saw a nice improvement of about close to 15 percentage points. So we're hearing that from our contacts in general. Doesn't necessarily mean that they are getting all the applicants they want by a long shot. We also started asking them, what is the biggest challenge in finding new employees? And we've been hearing this pretty consistently, but now we have a little bit of data behind it, is that most are saying either applicants do not have the right skills or experience, or they just don't have enough volume, that they would like more people to choose from. And we also are hearing again about that wage expectation as labor and firms are trying to negotiate that wage. A lot of workers are asking for wages that firms aren't either able to or willing to pay, which is obviously creating some difficulty for employers to find the right labor. Speaking of wages, here we're seeing, I would say, a fairly consistent picture. It's kind of plateauing. So wage growth is stabilizing. I think the problem for firms is that they are it's stabilizing at a pretty high level. So if you go back to 2 years ago, what you're seeing is more firms are giving increases and more firms are giving larger increases, that dark green increase of over 5%. What's driving it is mostly large firms. So if you go to the chart on the right, okay, and as you can see here, large firms are not only giving wage increases universally here. Not everyone is increasing them by a large amount, but a larger share are increasing them by a high amount. If you go, to the smaller firms, the 1 to 10, you are seeing the difficulty that small firms have in competing on wages. They're just not able to give as high of increase. It's probably why they are struggling more to be able to fill their labor needs. So outlook, I think there's I would not say it's a fantastic outlook by any stretch, but if you compare it to last summer, so again, the bottom bar versus the third from the bottom, July 2022, there's a marginal improvement, but again, given the course of the economy, given the course of prices and interest rate environment, I would actually call the fact that it's marginally better is a small win. I guess probably not any better than that, because this is not a wildly optimistic outlook, but it is optimistic. So just a few final thoughts kind of as a recap. So again, revenues were mixed among all respondents. I think really importantly, and this should be stressed, profits are still kind of under attack right now. Hiring demand is still solid. It has pulled back, especially among those firms that are looking to add permanent full-time workers. We are seeing that also in the job openings data. So we're hoping that maybe it is planing out and finding a plateau, maybe at a little bit lower level than it was. And I think that that's not necessarily even a concern because job openings were so strong for so long that I think some moderation is still going to leave plenty of openings for people that are interested in work and maybe gives some relief to employers. Inflation is continuing to decline, more so at the retail level, not a lot, but it is improving. It's going in the right direction. The bigger concern for firms now, what they told us, are interest rates and financing costs. Labor availability is still a problem, but again, that too is getting better. Wage pressure has plateaued at pretty high levels. That is good for workers, not great for firms. But the outlook is net positive. And one of the things that I would say overall is that, I think as I take a look at the big picture here is that I don't think these results are stellar by a long shot. But what I get out of this is that there seems to be a fair amount of stability in what firms are reporting. We're not seeing major increases or decreases in any particular area. And many of the indicators, profits acknowledged, absolutely, but a lot of the other indicators are seeing either stasis or some modest improvement. And I think that's a good sign for the economy. I think it also indicates something that I've been seeing over and over again, and that is resilience in the business community. It seems like whatever challenge is there, it certainly is hurting firms, and I don't want to discount that, but there are enough firms that are able to make changes or otherwise deal with the challenges to still remain going concerns, profitable, maybe not as much as they would like to, but still able to see growth. So Haley, I'm going to hand the rest of it over here to you.
Great, thanks, Ron. Before we jump into Q&A, I want to share some information about the other surveys we conduct. In addition to the general business survey, we also survey businesses across a variety of sectors. Right now, we have a hospitality and tourism survey in the field and a construction survey coming up in November. None of these surveys would be possible without the support of our survey partners. Our partners span the 9th District and come from organizations like chambers, economic development centers, state agencies, and more. These partners help distribute our surveys to their business contacts so we can get a greater understanding of current economic conditions. If you're from an organization that would like to become a partner on future surveys, please scan the QR code on your screen or click the link that I sent in the chat to learn more. I'll be reaching out to those who sign up. So with that, Ron has some time for questions. If you have questions, please type them in the chat box on Zoom. Let's start with this one. Are there any sectors or indicators that you're watching outside of the survey that might give some added color to the current state of the economy?
Thanks. Interesting question, Haley. I guess the one area that I would point to that I pay a lot of attention to, and I can't really tell you exactly what direction it's going right now, is construction. I pay a lot of attention to construction markets, and I think there are both some good signs and some less good signs. We are seeing some improvement in single family permitting. The Twin Cities in July rose about 10% in terms of single family permitting. I'm seeing some recovery in some other markets in the 9th District. Now, that said, they've declined fairly significantly. So it's a long way, I think, to getting back to the pace that we were before interest rates were rising. We are also seeing we also do some pulse survey work, and in a small sample of construction firms there, they were seeing relatively decent activity, and they were expecting activity to increase going forward. Again, small sample, but I do pay a lot of attention to construction markets. I don't think we're out of the woods in a long way in terms of the construction market as a whole. We get some information from private organizations that suggests the value of construction starts over the summer has been pretty much on par with the last year and in 2021. Problem is, when you're comparing value, you have to take inflation into account. So the fact that they're level with previous years, not necessarily great because you have to factor in inflation for that. So we're seeing maybe some indicators that things are not as good as they could be. But again, given all of the challenges, the higher rate environment, it is, I think, again, a very resilient sector. One of the areas that I'm paying more attention to also in terms of construction is that I'm seeing some slowdown in multifamily. You're seeing that for sure in the Twin Cities, seeing it in a couple other markets, something that I'm hoping doesn't last. I think everyone watching here knows housing is a big problem across the 9th District, across the nation. We're hoping that we can start to see housing really start to recover going forward.
Great. Now we had a few questions about automation. Someone asked, is there any data that the Fed is collecting about the increased use of automation versus hiring people?
Yeah, it's a really good question. We don't collect data, at least that I'm privy to for sure, about the increase in automation versus hiring. What I would say is we certainly are tracking the amount of capital expenditure and things like that. What we don't know is when you make a capital expenditure, you don't have to mark down, okay, I was able to get rid of 3 employees as a result. So we don't know exactly what's happening in labor markets as it relates to automation. I would say a couple things about that. For one, automation has always been happening. So I think without question, there are a number of firms that are looking to automation to improve their need for labor. I don't think there's any question about that. As labor markets get tighter, I would expect us to continue down that road. What I don't see necessarily is any wholesale change to capital investment, because we do track capital investment, and I'm not seeing anything in the data that suggests there is this huge wave of automation kind of ready to wash over the economy that's going to kind of alleviate everybody's labor problems.
Great. Someone asked, my manufacturing business revenue is up because I've increased prices, but units are down, which I feel is a bad sign going forward. Do you see any of that in your revenue data?
Ask me that question again, a little slower this time, Haley.
For sure. My manufacturing business revenue is up because I've increased prices, but units are down, which I feel is a bad sign going forward. Do you see that in any of your revenue data?
As a matter of fact, yes, I would. I can't say specifically about manufacturing. What I can say is I'm actually hearing this in the hospitality and tourism area, where some hotels are not seeing maybe as high of occupancy, but they're still seeing strong revenues because their average room prices have gone up. So I think it's the same concept, and I do think there is something about that. It's the same in construction. You're maybe not building as many houses, but the selling prices of those are higher. Doesn't necessarily mean you're making greater profits, again, because your input costs are a lot higher. So I do think there is something in that. I wouldn't call that a positive trend by a long shot, but if we can get a control of inflation, then I think hopefully some of those things start to even out a little bit. I hope I answered. That was a great question. Hope I answered it.
Looks like we have time for one more question. Someone asked, have you picked up anything related to the de facto stimulus coming from the employee retention tax credit as sustaining outlooks?
Honestly, that's not something that I have looked at specifically, so I wouldn't have much to say on that in one in particular.
All right. Well, that will be our last question for today. Thanks so much for joining us. More information will be in our follow-up email to this event. And please join us for our next virtual event, Regional Economic Conditions, Insights from Workers and Job Seekers, on Friday, September 8th. And with that, I hope everyone has a great day.